Hello, this is Bob Steele. In this lecture we will continue on Chapter 6. I'm talking about inventory, and this time we're going to talk about determining inventory costs. So determining inventory costs include all expenditures necessary to bring an item to a sellable condition and location. So you would think the inventory cost to us would be fairly self-explanatory. What's the inventory cost? That's what we paid for the inventory. So obviously that will be included in the inventory cost. So if we sell cars and we bought the car from somebody else, the cost that we bought the car for would be part of the inventory. Or if we sell refrigerators and we bought the refrigerator and we're going to then sell it later, obviously the cost of the refrigerator would be included in our inventory. But there's other items that need to be included in there as well. So if we talk about we're going to subtract out any discounts. So if we paid, for example, within the discounted period, then we would have to subtract out that discount that we paid from the inventory. If we have any import fees, so if we bought it from another country and we had to pay for the import fees, that would be included in the cost of the inventory. We wouldn't have an account that said import fee expense. We would include it in the inventory because that expense of the import fee is part of what we needed to get that inventory to us. The same logic goes for freight. If we're the one that paid for the freight, we're not going to expense the freight. We're not going to say it's freight expense. We're going to include that freight in the cost of the inventory because in order to get the inventory into our warehouse and our stores to sell it, the freight is included. Again, that's the freight from the person we bought it for, the company we bought it for, to us if we are in charge of paying that. Insurance, if we had to pay for insurance. If we bought something from China, we paid for the shipping, and if we have to pay the insurance to insure it on the way here, because if it gets lost or pirates take it on the way, then we want to make sure that we're covered. That insurance is part of the cost of getting that inventory to us and therefore should be included in inventory. It's not going to be insurance expense. It's going to be included in inventory and will be expensed when we sell the inventory in the form of cost of goods sold. And then storage fee. If there's any storage that needs to be done on the way from the seller to us, that storage fee then should be part of the cost of the inventory. So internal controls and taking a physical count. So most companies take a physical count of inventory at least once a year. So there's two types of inventories methods we could use. We can use a perpetual system or we can use a periodic system. The perpetual system would be the preferred system. A periodic system would be something where we only do a physical count. We purchase the inventory goes up, then we count it at the end of the time period. So for example, if we had 5 items and then we bought 5 more items during the time period, during the month in this case, that means we would have 10 items that would be available for sale. And if we then counted the items at the end of the month and we only had 8 left, then we would say we had 10 available minus the 8 means that we must have then sold 2 of those items. That would be a periodic inventory system, and that means that we would not be recording the decrease in inventory as we sell it. We would only be recording it as of the end of the month. So when we sell something, we would just record the debit to the receivable or cash and the credit to sales. And then we wouldn't record the debit to cost of goods sold and the credit to inventory until the end of the month. And that's not the best way to do it, but that's an easy way to do it because sometimes it takes some more advanced software in order to get the cost of the goods sold recorded on real time. So for example, when you go to the supermarket and you post something through and they scan it, then you see the sales price, meaning you can see the scanners taking into account the cash that they're going to receive, debit, and credit the sales. You don't see the cost of goods sold. It's not on the sticker. So the software that they have then is sophisticated enough to record the other half that we don't see, which is a debit to cost of goods sold and a credit to inventory. So in a sophisticated system, we're going to decrease the inventory during the point of sale, but we still have to count it at the end of the time period. And for a perpetual inventory system, that's more of a check, a balancing check to make sure that an internal control that the inventory is being processed correctly. So we're going to do a physical count as of the end of the time period. In the grocery store, we're going to count everything. And then we're going to compare it to what the books say is on there in the perpetual inventory system. And a lot of times the count will be less than, of course, what the perpetual inventory systems. Why might that be? Could be theft, could be shrinkage, we'll call it shrinkage, but it could be theft, it could spoiled, and all these types of things that could have happened. Then we'll have to write down the inventory to the physical count. So that's going to be an internal control, meaning we're trying to safeguard our assets. So good internal controls over count include, we have pre-numbered inventory tickets. So pre-numbered items are going to be less likely to fraudulate because they're pre-numbered on there. Counters have no inventory responsibility. So the people that handle inventory should not be the ones that also count the inventory and check their own work. We need to have someone else check the work so that we have this separation of duty. And then counts confirm existence, amount, and quality of inventory item. So that we want to know these three things. Is the inventory there? Does it exist? How much is there? And then we want to know, is it still good? Is it spoiled or not? And then second count is taken. Oftentimes if we double the count, that would be a double assurance that simple mathematical error didn't happen in counting. And manager confirms all items counted. So we'll have a check from the management to confirm that this has happened. Again, separation of duty. And then inventory cost under a perpetual inventory system. Inventory affects the matching principle, requires matching costs with sales. So under the perpetual inventory system, as stated before, we are going to record the decrease of inventory at the same time as we sell it. It takes a little bit more sophisticated software to do it, and we as consumers don't always see this. Neither do the salespeople. If the cashier really only sees the sticker price, just like we see. So if we brought something up to the cashier at the grocery store and it's $10, they're going to ring it through, and we're going to see that it's $10, meaning we're going to debit cash and credit the sales for $10. What we don't see is the cost. But if the software is sophisticated enough, it should be recording the cost at the same time. That would be a perpetual inventory system, thereby recording the debit to cost of goods sold, the expense related to the use of the inventory, and crediting reducing the inventory at that point in time. Inventory cost flow assumptions, management decisions in accounting for inventory are as follows. Items include in inventory and their cost. So this is an assumption of the flow of inventory. Now, if we sell something big like cars or something like this, whatever car we sold, we know exactly what we bought that car for because they're very big, they're distinct. We have a different number for each car, and we're going to tie out the exact car to the sale of that car. But if we're talking about other types of things, we're talking about nuts and bolts, we're talking about selling milk or vegetables or these types of things, obviously, we don't know exactly what that particular carton of milk cost us, and the cartons of milk could cost us different prices over time as things change. Things change over time. If all else is equal, prices increase over time due to inflation. So all else equal, you would expect that we buy the same amount of milk, but over years and months and years, the cost of the milk will go up due to inflation. There's a lot of other factors that could go down because there's more cows or something as well, but all else equal, you would think that due to inflation, costs generally rise over time. So we're not going to actually track that carton of milk necessarily. What we're going to do is just assume what happens. And the assumption does not have to line up exactly with the reality. For example, most people think of FIFO, and that would be meaning that we're going to sell the first one in is the first one out, meaning the milk that we bought the earliest is the first one we sell. And this lines up to the way we generally stock the shelves, because if you ever stocked a shelf, obviously what you do is you take the old stuff and put it up in the front, and you put the new stuff in the back, hoping to sell the new milk and not the old milk. So, and by the way, of course, if you're buying the milk, what you do is reach to the one in the back, hoping that you got the freshest one and not the oldest one that's probably in the front. But in reality, it might not be in that case. We might sell it in a different order. That's just an assumption. LIFO means that we're assuming that we sell the last in, first out, meaning we're selling the newest one, the one that just came in, we're going to sell. This one doesn't really make a lot of sense for reality because that's not what we're going to try to do, but the assumption does work and it has tax effects that are beneficial sometimes.